Bismillahirrahmanirrahim. Assalamualaikum. My name is Wad Anas Fakir. My group will represent the topic of balancing risk, market, and also instruments. What is balancing risk? Balancing risk is managing how much uncertainty or potential losses that you are willing to accept. Next, what is balancing market? Balancing market is market conditions before making investment conditions. And the last one, what is balancing instruments? Basically, balancing instruments is the financial tools you invest in. You must balance different type of instruments to create a stable portfolio. Why these three matters important in investing? First, they protect you. Second, they provide you to make a decision. Third, they will maximize your return. Before we go further, I will explain about risk and return. So risk is the chance that you might lose money, and return is the profit you expect to earn from an investment. So the relationship between the risk and return is positive and direct. So if the risk is increased, then the returns also will increase. So we can conclude that risk and returns are moved together. For example, low risk, we have fixed deposit. Medium risk, we have blue chip stocks. And the last one, high risk, we have cryptocurrency.
Today we are going to talk about systematic versus unsystematic risk. First of all, let's know the definition of systematic risk. Systematic risk is a type of risk that affects the entire market or a large group of assets. It comes from broad economic forces that investors cannot control. For example, systematic risks include changes in interest rates, inflation, recessions, political instability, any global events like pandemics or wars. Because these factors influence the whole market, systematic risk cannot be reduced through diversification. No matter how many assets you include in a portfolio, this market-wide risk will still remain. Next, on the other hand, we have unsystematic risk. Unsystematic risk is the type of risk that is specific to a single company or particular industry. It arises from unique firm-level events such as mismanagement, product failures, lawsuits, business competition, or industry strikes. Unlike systematic risk, it can be reduced or even eliminated through diversification because the negative performance of one company can be offset by the positive performance of others in a well-diversified portfolio. In summary, diversification is effective in reducing unsystematic risk, but it cannot eliminate systematic risk, which affects all assets at once.
In financial markets, there are several mechanisms that help investors manage risk. The first is diversification, which means spreading investment across different assets, industries, or market by not putting all your money in one place. Losses in one asset can be offset by gains in other, reducing unsystematic risk. The second mechanism is hedging. Hedging uses financial instruments like futures, forwards, and options to protect against unfavorable price movements. For example, a company can hedge currency or commodity price to lock in future costs and reduce uncertainty. Next is liquidity. Liquidity refers to how easily an asset can be converted into cash without affecting its price. Highly liquid markets reduce risk because investors can quickly buy or sell assets, especially during volatile periods. Finally, the spread of information helps reduce uncertainty in the market. When information is widely available and shared quickly, investors can make better decisions. Prices become more accurate and information asymmetry decreases. This improves market efficiency and increases confidence. Overall, diversification, hedging, liquidity, and efficient information flow all play key roles in reducing financial risk and creating more stable market environment.
For regulatory roles in managing risk, regulatory bodies exist to oversee and control financial markets. Their main role is to make sure all investment activities follow proper rules are transparent and operate in an orderly manner. They reduce their risk by preventing fraud, monitoring listed companies, enforcing laws, and ensuring that investors receive accurate and reliable information. In short, regulators help keep the financial market stable, trustworthy, and safe for everyone. In Malaysia, two key regulators play an important role in managing risk. The first one is Securities Commission Malaysia, or SC. SC supervises the capital market, which includes shares, bonds, and unit trusts. They ensure that companies and financial intermediaries follow the Capital Markets and Service Acts. The SC also licenses investment advisors and monitors the conduct of market participants. The second one is Bursa Malaysia. Bursa Malaysia operates the stock exchange. Their role is to make sure all buying and selling of shares happen in a fair and orderly way. Bursa monitors listed companies to ensure they disclose accurate financial information and comply with listing requirements. I think regulation is important because it promotes fairness and protects investors from unnecessary risks. With proper regulations, companies are required to provide truthful, timely, and complete information. Regulators also prevent insider trading, market manipulation, and other unethical practices. This ensures that all investors, whether big or small, can make decisions based on reliable information. In overall, regulation help create a fair, transparent, and well-protected financial market.
Alright, so the last one is matching risk profiles to instruments. First, we need to understand that different investors have different risk profiles, which means how much risk they can tolerate. There are three main types of risk profile. The first one is conservative. This investor prefer safety and stability. They don't like a big chance in investment value, and they want low risk options. The second one is moderate. These investors are okay with some risk, and they want a balance between safety and better returns. And the last one is aggressive. These investors are willing to take high risk for higher return, and they are comfortable with market fluctuations. Alright, so for example, for each profile, the first one is for conservative investors, such as fixed deposit, government bonds, or money market funds, because they are stable and low risk. The second one is for moderate investors. They can choose balanced unit trust or a mix of stock and bonds, because they give moderate return with moderate risk. And the last one is aggressive investor. They can invest in stock, cryptocurrencies, because these have high potential returns but also higher risk. Alright, so why matching risk profile to instrument is important? This is because it ensures suitability. Every investor has a different comfort level when it comes to taking risk. By selecting the right financial instrument based on their risk profile, it helps protect them from losses they cannot handle, and ensure that the investment matches their financial goals and allows them to invest more comfortably without feeling stressed. So as conclusion, balancing risk, market and financial instrument is essential for making smart investment decisions. By understanding different types of risk, the role of market and regulators, and choosing instruments that match risk profiles, investors can manage their money more effectively. So that's all from us. Thank you.